Hi, this is Jason, and today we'll run through the basics of the concept of risk mix. Initially, we'll look at burn costs and the contributing factors for it to change over time, and then we'll isolate risk mix in particular and go through a mathematical notation to define it, and then finally we'll apply a basic example to illustrate real life how this comes about. In terms of claim cost, the two factors of interest are claim frequency and claim severity. And together, these make up burn cost, which is essentially the expected claim cost per given policy. Now, the question to ask is how does claim experience change over time? And there are three key influences to this. Number one, claim cost inflation. So we could talk about the cost of parts, the cost of repairs, even the cost of labor, for instance. The second is random volatility. They could be an unforeseen event that is, say, a 1 in 1,000 event that could be exceptional for a given year. And then the third one, and the focus of this presentation, is of course mix of business. So how does your selection of risk influence your claims experience? If we go through the mathematical notation and consider F to be the expected claim frequency, so this would be obtained from modeling. And if we consider the situation where the frequency, the claim frequency of risk 1 is greater than the claim frequency of risk 2. So if we look at the combined frequency, here we see again the frequency of risk 1 and the frequency of risk 2. And we've also got attached a number of policies written with the respective risks. So 100 policies of risk 1 written and 500 policies of risk 2 written. And essentially the weighted average frequency is in the value A. If we go down further in time, so t plus 1, again, we still have the expected claim frequency of risk 1 and 2. But what's different here is, say, a year down the line, we actually write 4 times as many of risk 1 than we did in the year before. But at the same time, we maintain the number of policies of risk 2. And essentially, we get an average weighted frequency of value B. But since we know that risk 1 is more probabilistically high in terms of claim frequency than risk 2, we know that B is going to be a larger value than A. So now that we've got the frequency in the respective time periods, we can look at it in index form. So if we start from the first period, time equals t, then if we divide that by itself, then we get 1. So that really defines the base period or the year that the figure is indexed to. And then we look at that subsequent period of t plus 1. And essentially what we're doing is just a ratio of ft plus 1 over ft. And this will be greater than 1 because we know that b is greater than a, given that the expected claim frequency is unchanged in terms of their underlying claim frequency modeled. If we take a simple example just to illustrate the point, we can consider risk 1 as under 25-year-old drivers, and their expected claim frequency is 30%. Whilst for risk 2, we have, broadly speaking, 25-plus-year-old drivers, and their expected claim frequency is 15%. Here we can tell that under 25s are more risky than 25 plus in terms of probability of making a claim. In fact, in this example, under 25s are twice as likely to make a claim than 25 plus year olds. If we look at the combined frequency function and consider, say, year 2022, if we plug these frequency figures in, then essentially we get a combined weighted average frequency of 70.5%. If we consider a year later, as we saw in the example, the year later we write 4 times as many policies in risk 1. And this gives a weighted average of 21.7% frequency. So as we can see, the combined expected frequency, claims frequency, has increased, and that is a function of writing more of the riskier business, a higher proportion of the riskier business. And then if we put this into an index format, with say 2022 as the base year, we get a value that is greater than 1 in 1.238. So the idea of a risk mix index is over time, and this can be on a quarterly basis and over the years, we have these figures that represent or give an idea of how mix has changed relative to the base year 2022. So each year will always reference against the original base year and keep that consistent. The reason risk mix can change can be many reasons. One obvious one would be pricing. So for instance, the prices for under 25-year-old insurance coverage is too low, too cheap. And as a result, it attracts a lot of under 25-year-olds, which are worse experienced than say 25 plus, to accept business with us because the price is favorable to them. As a result, that can increase the number of policies sold to the riskier business, and as a result of that, results in worsening risk mix. But this is a very crude example where we're just looking at age and segmenting that by under 25s and 25 pluses. Within this, you can have like type of vehicles, engine size, between the two, and so forth in a ultimately a multivariate perspective to give risk mix. But this is just a very simple example to illustrate the point of risk mix or mix of business changing within the book over time. And when we look at claim costs, this is quite important because we want to know what the underlying claim experience is. And as we saw with the burn cost example, we can strip out, say, exceptional events, and we can strip out the effect of risk mix, and then we're left behind in terms of claim costs being affected by claims inflation. So this allows us to strip back claims experience to give us a more purer view of underlying claims experience.